You are 49 and you have $100 million in investable assets. You are sitting in a private meeting room on the 31st floor of a building that does not have its name on the outside. The room has no windows facing the street, only a single wall of glass looking inward at the trading floor below, which hums with the specific frequency of money in motion. There are three people across the table from you. None of them are salespeople. They are called relationship managers, which is a different thing, and the difference costs approximately $40 million in assets under management to access. They flew in from two cities for this meeting. You did not fly anywhere. 15 years ago, you called a brokerage's 1-800 number and waited 11 minutes on hold to ask a question about a $100 investment in an index fund. The person who answered was 23, reading from a script, and mispronounced the name of the fund. By the end of this video, you'll definitely see that Wall Street doesn't have clients, it has asset levels. And at each level, the product changes, the access changes, the language changes, and the way they look at you when you walk through the door changes, in ways that are invisible until you've seen all 10 levels from the inside. You'll find out exactly where you are on this map and why. This is how Wall Street sees you. Level 1, $100. You are 24 and you have $100 to invest. You found the brokerage through an ad on your phone. The ad said no minimums, commission-free, start with any amount. You downloaded the app in 4 minutes. The onboarding took 7. You bought a fractional share of an index fund and watched the number, $100, become $99.40 on the first day due to a market movement you didn't understand and a spread you didn't know existed. You call the support line with a question. You wait 11 minutes. The person who answers is reading from a script. They answer a different question than the one you asked, but in a way that sounds like the same question, and you don't know enough yet to identify the difference. The app sends you notifications, not about your investment, about features, about premium tiers, about a debit card with cashback that requires a monthly subscription. The app is not a brokerage. The app is a funnel, and your $100 is not the product. Your attention and your eventual upgrade are the product. You are not a client at $100. You are a user. The distinction matters in ways that will take years to fully understand. The first rule, at $100, Wall Street is not serving you. Wall Street is acquiring you at the lowest possible cost in the hope that you become worth serving later. Level 2, $5,000. You are 26 and you've been adding $200 a month for 18 months. The account has $5,000. You are no longer using the app with the notifications. You moved to a real brokerage 6 months ago, the kind with a website that doesn't look like a game. The interface is less exciting and more functional, and the difference between those two things is the first financial maturity signal you didn't know you were sending. A representative calls you, not to discuss your portfolio, to introduce you to the brokerage's guided investing service, which charges 0.35% annually to put your money in a pre-built portfolio of ETFs you could have assembled yourself in 40 minutes using free information that exists on the internet. You ask if there's a human advisor who looks at your account. He says the portfolio is managed algorithmically, with periodic human oversight. You ask what periodic means. He says quarterly reviews. You say you'll think about it. He says he'll follow up next week. He follows up next week. You say yes because the call was easier to end with yes than with a more specific no. The 0.35% fee on $5,000 is $17.50 a year. You do not think about this number. In 15 years, when the account is larger, the same percentage will be a different conversation entirely. The second rule, at $5,000, the brokerage is selling you convenience. Convenience is always more expensive than its sticker price, and the sticker price is always presented as a percentage rather than a dollar amount for a specific reason. Level 3, $25,000. You are 29 and the account has $25,000. You now qualify for what the brokerage calls their Select tier. The Select tier comes with access to research reports, a dedicated phone line that skips the general queue, and an invitation to a quarterly webinar hosted by a senior analyst who will discuss market outlook in terms designed to be impressive rather than actionable. You attend the first webinar. The analyst uses 14 terms you have to look up afterward. The overall message is that markets are complex and professional guidance is valuable. This is true. It is also the entire point of the webinar. A financial advisor reaches out. He has a name, not a representative, an advisor, a person with a business card and a LinkedIn profile and a set of initials after his name that represent certifications you haven't researched yet. He suggests a meeting to discuss your financial goals. You agree. The meeting lasts 50 minutes. He asks about your income, your timeline, your risk tolerance. He recommends a managed portfolio at 1.2% annually. On $25,000, that is $300 a year. It sounds reasonable because he presents it as $300 rather than as the compounding cost over 20 years, which is a number neither of you mentions. This is also the level where most people make the mistake I broke down completely in another video, the middle-class income trap, where a $100,000 salary produces less wealth than a $50,000 salary, because the fee structures, the lifestyle expectations, and the financial products marketed to people at this income level are all designed to extract the surplus before it compounds. I deconstructed exactly how that works in the video appearing right now. But for now, let's look at what happens when the account crosses $100,000, and the language in the room changes for the first time. The third rule: at $25,000, you are worth a person's time. That person's time is not free, and its cost will be expressed in percentages because percentages are harder to feel than dollars. Level 4, $100,000. You are 33 and the account has crossed 6 figures. The brokerage sends a letter, not an email, a letter, on paper, in an envelope with your name printed cleanly on the front. The letter welcomes you to their premier client tier and informs you that you have been assigned a dedicated wealth advisor named Michael, who will contact you within 3 business days. Michael contacts you within 2. Michael is 34, well-dressed on the video call, speaks with the specific fluency of someone trained to make complex things sound simple and simple things sound complex, depending on which serves the conversation. He knows your account history before you say a word. He has a proposal ready, a diversified portfolio across 6 asset classes, actively managed 1.4% annually. On $100,000, that is $1,400 a year. Over 20 years at average market returns, the compounding cost of that 1.4% versus a 0.03% index fund is approximately $180,000 in foregone returns. Michael does not mention this number. You do not know to ask for it yet. You approve the proposal. The account performs adequately. The market does most of the work. Michael emails quarterly with a report that is 4 pages long and contains 1 sentence of genuine insight surrounded by 3.5 pages of context. You feel like a client now. You are. The product has changed. So has the price. The 4th rule: at $100,000, Wall Street begins investing real attention in you. Real attention in this context means real extraction, executed with genuine professionalism. Level 5, $250,000. You are 36, and Michael has been replaced by someone named Catherine. Catherine is a senior advisor. The transition was presented as an upgrade: higher tier, more experience, broader resources. It was also an upgrade in the fee conversation. Catherine's recommendation includes alternative investments, a private REIT, a structured note, a small allocation to a hedge fund with a $100,000 minimum and a 2-year lockup period. The products are more complex. Complexity serves multiple functions in wealth management. It justifies the fee, it creates dependency, it makes switching advisors feel risky because understanding the position requires understanding the products, and understanding the products requires trusting the person who sold them to you. You ask Catherine to explain the structured note in plain language. She explains it clearly. You ask what happens if you need the money before maturity. She explains the exit costs. You write the number on your legal pad, a habit you've had since the beginning. Same yellow pad, same pharmacy. And you look at it for a moment before nodding. You are starting to read the room differently. Not with suspicion, with literacy. The products are real, the returns are real, the relationship is real. And the incentive structure underneath all of it is also real. And learning to hold both truths simultaneously is the actual skill this level requires. The 5th rule: at $250,000, the products get complex because complexity is a service and a moat simultaneously. Your job is to understand what you own well enough to know when complexity is working for you and when it is working for the fee. Level 6, $1 million. You are 39 and you are now what the industry calls a high net worth individual. The designation is not ceremonial. It unlocks a specific tier of products, access, and treatment that is structurally different from everything below it. The minimum investment thresholds drop for certain private funds. The invitation list for certain events becomes available. The conversation in the advisor's office changes register, from planning to strategy, from saving to structuring. Catherine introduces you to an estate planning specialist and a tax attorney who works with the firm. The three of them present a coordinated wealth strategy: investment, tax efficiency, estate structure, in a 2-hour meeting with printed materials in a leather folder. The folder has your name embossed on the cover. The embossing cost them $4 and signals something worth considerably more. You now have a team. Not a person, a team. Each member of the team knows your situation, coordinates with the others, and contacts you proactively rather than reactively. A market event happens on a Tuesday morning, and Catherine emails you by 9 a.m. with context and a recommended response. This is different from level 4, where the quarterly report arrived and the market had already recovered. The fee has also evolved. No longer a simple percentage, but a tiered structure with components across management, advisory, and product. The total is around 1.1%, but requires a conversation with the estate attorney to understand fully. That conversation is free, approximately. The sixth rule: at $1 million, Wall Street stops selling you products and starts selling you a system. Systems are harder to price and harder to leave. Level 7. $5 million. You are 42 and you receive a call from a private bank, not a brokerage, a bank. The distinction is significant. Private banks operate on relationship economics that function differently from the fee-based model below this level. They make money on the aggregate relationship, which means they have a structural incentive to keep you whole rather than to maximize product revenue from your account. The private banker's name is James. James manages fewer than 30 relationships. He knows the names of your children. He knows about the property you're considering because you mentioned it in passing 4 months ago, and he made a note. The note exists because losing your relationship would matter to James's career in a measurable and specific way. The investment minimums that applied at level 5 no longer apply. A private placement that requires $1 million minimum from outside clients has a $250,000 entry for you because the relationship justifies it. This is not favoritism, it is the price of capital at scale, operating according to rules that are real but rarely stated. You attend a dinner. 12 people, a guest speaker who runs a sovereign wealth fund, a view of the city from a room you weren't aware existed 3 years ago. Money is not discussed at the dinner. Money is the table. The seventh rule: at $5 million, the relationship replaces the product, and relationships, unlike products, are not disclosed in a fee schedule. Level 8, $20 million. You are 45, and the term used for you internally is ultra-high net worth. The term means that 3 people at the private bank exist partially because of your account. Not entirely, they have other clients, but partially. Your relationship is a line item in someone's performance review. The institution does not compete to acquire you anymore. The institution organizes itself to retain you. The deals are bespoke, not selected from a menu, structured specifically for your timeline, your tax situation, your estate plan. A real estate opportunity is brought to you before it is offered to anyone else, because your participation at your scale changes the economics of the deal for the sponsor. You are shaping transactions rather than entering them. Your private banker flies to meet you. You do not go to the bank. This inversion, which began subtly at level 5 and is now complete, is the clearest signal of where you sit in the hierarchy of capital. The 8th rule: at $20 million, you are not a client. You are a partner whose continued presence is worth protecting at the institutional level. Level 9, $50 million. You are 47 and the chief investment officer of the private bank calls you directly. Not to sell you something, to ask your opinion on an emerging market allocation strategy they are developing for their institutional clients. Your experience, your perspective, and your implicit endorsement of the strategy, if you participate, has value to them that exceeds the fee revenue from your account. You are being consulted by the institution that manages your money. The dynamic that began at level 1, where they held all the information and you held none, has inverted so completely that it is barely recognizable as the same relationship. 2 investment banks have sent preliminary term sheets for co-investment opportunities in private equity. The deals are pre-market. The returns, historically, on this category of deal, at this level of access, have been meaningfully above what is available to anyone below level 7. The compounding effect of access, over time, is the actual mechanism of generational wealth. Not the returns on the deals, the access to the deals. This is what level 1 cannot see from where it stands, and what level 9 can no longer remember not knowing. The ninth rule: at $50 million, the information asymmetry reverses. You know things about markets and deals that the public will learn 6 months later, if at all. Level 10. $100 million. You are 49 and you are sitting in a room with no name on the outside of the building. 3 relationship managers flew in from 2 cities. You did not fly anywhere. The meeting is about a co-investment opportunity in a private infrastructure fund. $8 million minimum, projected 10-year hold, returns discussed in terms of IRR and multiple on invested capital rather than annual percentage. The language itself is a gate. People who don't understand the language don't belong in the room. You understand the language because you've been learning it for 25 years. After the meeting, you take the elevator down alone. The lobby is marble and quiet. The security guard nods. You push through the revolving door into the city. You stop at the same coffee cart you stopped at on the day you made your first $100 investment. The coffee is $3.50 now, up from $2.25. You pay in cash. The woman behind the cart doesn't know who you are. She gives you the same coffee she gives everyone. You stand on the sidewalk for a moment. Somewhere, right now, someone is on hold for 11 minutes waiting to ask a question about a $100 index fund investment. The person who answers will mispronounce the name of the fund. The investor will not know enough yet to notice. They are not a client. They are a user. They are the beginning of a journey that, if they stay on it long enough and learn the language at each level and refuse to confuse access with wisdom, leads to a room on the 31st floor where 3 people fly in and you do not. The system does not hide this. It simply does not explain it. The explanation is the work. And the work starts with the $100 and the 11-minute hold, and the mispronounced fund name, and the decision to stay on the line anyway. Stay on the line.